please.
Okay, we're away. I believe there was an earthquake near Vanuatu, 6.9 on the Richter scale.
Well, an earthquake to me is when a building collapses or a big rock falls down or someone gets injured.
Yeah.
Yes, there was an earth tremor, and we have earth tremors every single day, which we don't feel. The last big earthquake here was about 10 years ago when a big boulder fell down on the road to the wharf where the P&O ships come in. So, yeah, full on earth tremors.
Yep.
The Richter scale, by the way, was abandoned about 5 years ago because it's not accurate, but still people still use it. A bit like beta and VHS.
Mm-hmm. Yeah. Yep. Question, what are the maximum bars that you would forget counting?
Maximum bars that I would forget counting.
Forget the counting, yeah.
Counting what? The break of the promise.
The break of the promise, yeah.
Okay, I'll cover that when the whole group's there.
Yep.
But again, that's something that one's own stats will establish. Do you stop after 1 or 3 or 15 or 35?
Mm. Okay.
The whole concept of the cyber tutorials, Gary, is for people to roll their sleeves up and get dirty and do some actual practical physical work with the markets, whether it's with a printed off chart and a pencil and paper and sitting under a tree, as I push you to do, or electronically with software like Metascope or MT4 or the more specialized software packages that are out there as well.
Yeah.
And that way people start to build up an appreciation of what it is that they're looking to do, capture from the market, and the profile of the results.
Yep.
A lot of this will make more sense when we get into the session.
Yep. Okay, so we're a couple of minutes away. I'll mention that there are 2 handouts available for those who haven't received the homework. The handout is available in your go to screen box. There is a handout, and there is also a second handout there, which is a offer from FP Markets for attending and something for you to entertain. Greetings from Adelaide.
Greetings to Adelaide then. Maybe a blast from the past for me.
Yes. Ibrahim, yes, I can see that.
Actually white hair.
Yeah. Hello from Perth as well.
Say again?
Hello from Perth.
Perth?
Perth.
Perth's a good time zone to be trading American markets.
Yes.
But it's still in Australia, so sort of Mauritius would be a nicer place.
Yep. Hello from Melbourne, yep.
Melbourne, I spent some nice time in Melbourne in '95 doing up a motorhome.
What's the tax rate in Vanuatu?
Higher than Australia.
Yeah, it actually is, isn't it?
Well, what I mean by that, all the goods are tax, duty, and then VAT on top of that. Yeah. So it's certainly not a stereotypical Asian type destination to live cheaply. It's actually more expensive. In terms of direct tax, there are no direct taxes as an income tax, but there's a whole platitude or plethora of other taxation. And now they're talking about introducing income tax as well.
Okay. So we'll see you back in Sydney then.
I doubt that very much.
Okay. Okay. So we're getting hellos from everywhere here. St George in Queensland and the Gold Coast and Cairns and Canberra and Thailand and even from Sydney.
Even from Sydney.
Even from Sydney. Okay. We've just passed the half hour.
Done. Let's get the show on the road, so to speak, Gary.
Okay. On behalf of FP Markets, I would like to welcome Ivan Krastins to this tutorial. We've been working with Ivan for quite some time. Ivan is a career trader that has basically what you would call a market master these days. He started off with he was also a founding member of the ATAA, started the ATAA newsletter, and have you got the slide there, Ivan, of that?
I have already pressed the button. It should be on your side.
Can't see it.
As I said, in God we trust and rest pay cash. Huh?
Yes, that's right. I've got your introduction screen here. There we go.
Yeah, I'm on the next page.
There we go. So so for more than 20 years, Ivan has conducted his specialised workshops on trading systems design around the world before settling down in Vanuatu. He wrote a book called Listen to the Market. It is my personal choice of trading books. I read it almost 15 years ago. I've carried a copy of it ever since. It sits on my desk or in my briefcase, and I refer to it from time to time. So with that, I'll hand over to Ivan, and he'll take it from here.
Thank you very much, Gary, and we trust that technology will be kind to us. Let's go to the next page. You're seeing the next page, Gary? Tell me and I'll forget.
Yes, I am.
Right. Tell me and I'll forget. Show me and I may remember. Involve me and I will learn. It's an old Chinese proverb that I actually stick by. I know that I've read many books, been to many courses, but very few have actually reached out to me to roll my sleeves up and get dirty and participate and learn actively as opposed to passively. So thank you to all the participants that have come along. Thank you, Gary, for the opportunity as well. Now, in terms of formalities, there's a new email for Gary for the homework, FX homework at fpmarkets.com.au. Any questions you have in relation to anything I say or anything I show, just drop me a line to ivan@profitfrompatterns.com. It's true to say the story of one rule set, Gary, is there?
That's not yet. There we go.
Not yet. Experience that very few people are really committed to an intensive learning process before they open a trading account. Generally what happens, people get the idea, I want to become a trader, I want to trade for a living, I want to make $1 million. And they open up an account and start trading, and they want to learn by doing. Well, there's two ways to establish whether a knife is really sharp. You run the knife over your wrist, draw some blood, or you run the knife over a piece of paper. And if it cuts cleanly, the knife is sharp. One, two, three, four.
Yep.
1, 2, 3, 4.
Yep, I've got you.
1, 2, 3, 4. Gary, what's the last thing you heard?
1, 2, 3, 4.
So now before that, in relation to trading and a piece of paper and a knife.
Yeah, run a knife over a piece of paper and you'll find out if it's sharp, if it cuts cleanly.
Yeah, most people grab that knife and they run it over their wrist and the blood starts pouring out. And that's not the way to do it. In my eyes, spend the time, spend the money, spend the energy to do the homework first before you start partying with your hard-earned money. Over to you, Gary, in relation to a disclaimer that's supposedly legally is required.
Well, we'd only mention that tonight is for educational purposes only. We don't understand your financial situation, and we recommend that you consult a licensed advisor before acting on any information you may see or hear. So you may also have your disclaimer, Ivan.
I'll formal, Gary.
Yeah.
We're over 21. We're responsible for our own actions, and let's be responsible for our own choices. Make sense?
Yes, it does.
1, 2, 3, over.
Yep, we're here. Off you go.
Okay, so a formula that I adopted many, many years ago on screen is LIVETM. So the first part is look for an opportunity. It doesn't matter whether it's looking for an opportunity to date someone or to buy some real estate or buy a business. Always look around for opportunities, but before jumping in the deep end, you need to investigate that opportunity as to how to take advantage of it. What do you need to do, what rules need to be followed, what hoops need to be jumped through. The next part is very important, starts with B, verify for risk. And that's the only reality. Can I afford to take the risk? What happens if it doesn't work out? And then finally execute. Where this comes in line with trading in the markets is the TM part, which stands for timing and method. That's come across loud and clear, Gary?
Yes, it has. Yep.
Correct. The same saying again. The CyberTutorial and the assignment, we're going to be looking at one aspect of a bar, and that's referring to the range and where the range is in relation to the previous bar. So let me do this at this end. So there's one example there, and then the words down through there, and likewise for a bearish case. So you are, I'll be asking you to compile the stats in relation to the promised bar, promised up bar, also the promised down bar, and then to use your imagination to see what sort of potential RBT, rule-based trading system, or set of rules you can come up with. Not rocket science, but you'll need to look at how you want to enter on the basis of your stats, how you want to exit on the basis of your stats. Those two aspects I'll cover in more detail in the next seminar or the next workshop, but I'll give you some ideas today as well.
I just might.
So the more
just might come in here, Ivan. I've actually done this homework this week, and I would encourage everyone to work through these few sheets because the statistics are actually astounding.
Looking forward to seeing your results then, Gary. So on screen is page 1, and simply looking to mark a bar that has a larger range than the bar before and a lower low and a lower high, and you put a D above that, so it's a promise down. And then you want to see how many bars it takes before it fulfills that promise. So there's a promise of lower lows, and it took 1, 2, 3 bars to complete that promise that the market wants to go lower. In here we have a U, so that's a promise up. It's a larger range than the previous bar, which may not be obvious on the screen, and it takes the highs there. It takes 1, 2 bars to complete that. So it's a very straightforward exercise, and the numbers, as you said, Gary, are quite interesting.
They're staggering.
And very, very capable to be put together into a very robust RBT. Lack of money is not an obstacle. Lack of an idea is the obstacle. And that's a really important concept for anyone starting out. You don't need to have a big account to make a difference in your life and other people's lives. When you work with the knowledge capital that you need and the emotional capital to be involved with the markets. The markets have been around for a long time, and there's no reason to believe that they'll disappear tomorrow. Maybe the week after, but certainly not tomorrow. Typical cartoon type figures about the market, the ultimate battle. What does that represent to most people, Gary? The battle between the bull and the bear.
Yeah, the battle between the buyers and the sellers.
And my take on that is, as a trader, it's a battle between me and me. I have the rules. I need to have the discipline, the belief structure, and the faith to pull the trigger. I'll always have a committee on my shoulder saying, well, what about this and what about that? So to me, the real battle is between myself and my, what I call sub-C. It's always lurking around. The roller coaster, the game of chess, will arrive here in a similar path, looking for, I guess, the nirvana of an equity curve like that. You seeing the red line there, Gary?
Yes, Sam.
Great. And we come to the realization through the roller coaster of emotions, up and down, with seeking books, courses, clairvoyance. The moon cycle is actually quite interesting with the market as well. And we've come to the realization that it's a lot of discipline and perhaps hard work to to succeed. So today, what we'll be looking at, is the preparation part, knowing thyself, knowing yourself, knowing the enemy or the market, looking at different charts and time frames to use, an introduction to the language of the market, and also some ideas in relation to rule-based trading. So let's get the show really on the road. The DNA of the individual, everyone's familiar with DNA, I'm sure. Everyone has a different makeup, a different psychological profile. Someone in their 20s will have a different risk tolerance to someone in their 70s. Someone in their mid-30s with a family to look after may not have the time available that someone in their golden years or early years has. So everyone is slightly different. And it's important to understand the differences for yourself, and that way you can attract both the right market and the right RBT. One important aspect of trading is the IQ factor, which has got nothing to do with street smarts or otherwise. IQ stands for impatience quotient. How patient are you, Gary, to wait for the report card as per school as to whether it's a winning trade or a losing trade?
Yeah,
it's a rhetorical question.
Yeah.
Question, of course.
Yeah, it's a good question. It's something. I think it's one of the first things one of the first parts of the DNA is to work through, is that what really suits you here.
And how do you do that? It's always an interesting question.
Yeah, I did it by doing the homework. As you know, I've worked through lots and lots of charts. I've got piles of charts here that I've worked through, and I found that some time frames simply didn't interest me, and some did. That was what came up.
Okay, the aspect of impatience quotient is really looking to see how much time you have to devote interim period. So if you're using a daily chart, for example, it'll take you an entire day to find out whether the position you initiated today will be in profit tomorrow or not. Now, if you've got nothing else to do, well, maybe you can be sweating on it for the entire day. But if you're busy, the day will fly. Other people will want to trade on a 5-minute or a 3-minute chart basis or time frame basis. What dictates the time frame of the chart to use will be things like the internet connection, their own ability to recognize things, the spread being offered by the broker, the range of the market for that time interval. So there's many factors to consider in that. In terms of how to do it, top right-hand corner, Gary, can you see the computer-generated chart?
Not yet.
Patience is a virtue, the IQ factor, right?
There we go.
There we go. So the road ahead for people out there in Cyberland, from Thailand to Perth to Melbourne to Sydney to Timbuktu, there are many roads to Rome, but they all have one common element, and that is commitment. And when someone comes along to me and says, hey, Ivan, I want to learn from you, they ask me, how long will it take? My answer is, it'll take as long as it takes. Commitment is a really important factor. Whether you do that via computers and software, as per the top right-hand corner, or you do it as per the photo of Gary's homework on the bottom left-hand corner, where you did it by hand, pencil and paper.
Yeah, that's mine.
And then Gary said to me, but I'll take it to the office tomorrow to scan it. I said, Gary, you've got a mobile phone, use technology, take a photo, send me the photo. So he did. So there's many, many different ways to achieve the same end result. Next screen should be some handwritten notes on the right-hand side and a chart top left-hand side.
On its way.
Have the chart on screen, Gary?
Not yet. Not yet.
Not yet. It's a long way to swim across the pond, huh?
It seems to be.
Good goodness gracious. Any questions that come up in the interim so far?
Yes, I've got the monster question here while we're waiting for that.
I've got a monster answer.
Yeah, just let me see if I can. A strategy is a series of internal representations chained together in a sequence leading to a behavior. This is out of a book. Some strategies don't work very well and lead to outcomes you don't want, while others lead to outcomes you want. If this is going on unconsciously, you just have to take the results you get. And it will seem like the results are just happening to you. This is out of a book. Yep. They are generated from something outside of you. When you become aware that your mind creates these internal representations and how you chain them together into strategies, you can take control over the results you create. And it goes on.
Yes. And the important part is people is, do you like to lose money, Gary? Do you like to be wrong?
No, not.
And invariably the answer is no. But my answer is I love to be wrong because that gives me an opportunity to learn a different way of doing something. In terms of losing money, I don't mind losing money because it's part of a controlled loss and part of the bigger picture. For example, if one owns a restaurant, the 2 hours before the restaurant opens, the restaurant's losing money. 3 hours after the restaurant's closed, they're losing money. So losing is a natural part of any business venture. To dream that a market will, your account will go from 0 to $1 million in 3 easy days is la la land. So you've got the screen up now?
Yes, I have. Yep.
Great. So top left-hand corner is an example of a student who actually took the time to take the data and manually input it into Excel so he could automate some of the process. On the other hand, on the right-hand side was the way he took notes by hand. So a nice little contrast there from my side. Eye for detail is the next one. On screen?
Yes.
Great. Now, eye for detail, using my approach with the setups that I have, there's an image there of eye for detail. Every single bar has a message. There's some text above the bar and below the bar, and each text, each acronym has meaning to the student and to his own RBT. Now, some people do have an eye for detail innately. Other people have to work on it. A question I asked you, Gary, and I ask people again, is describe the fingers on your hand. Are they the long, slender, piano-playing type fingers, or are they other than that?
Mine?
And the answer, Gary.
Yeah.
No, your girlfriend.
No, I've got the builder's hands, I think.
Okay, well that means that you are challenged in terms of eye for detail. Someone who has a long, slender fingers naturally has the eye for detail. Someone who's an engineer, for example, would have an eye for detail. Someone who's a brain surgeon, hopefully, would have an eye for detail. An eye for detail is really critical when it comes to trading. Capital. What do I mean by capital? What sort of capital does one need to trade? Ask that to the group and see what responses come up, Gary.
Yeah, what sort of
capital does one need to trade?
What capital? Let's, okay, 5K, minimum 5K, $1,000, 25,000, 20,
so the first
20.
Focus, yeah. So
depends on.
Yeah, so the first focus is on.
Yeah, someone says someone else's. Money you can afford. You can afford to lose. 10K minimum, doesn't really matter. Funds to invest.
So everyone's focusing on the conventional use of the word capital. Another type of capital that's really important is knowledge capital. Because if you don't have knowledge capital, but you've got heaps of money capital, guess what? You're probably going to lose it. If you've got heaps of knowledge capital, you'll probably attract money. And the final aspect of capital is emotional, which I mentioned before. So the capital requirement is on 3 levels. And as you can see from the font size, the most important one is the emotional. Then the knowledge, and then the dollars are the least important from my side. Any raised eyebrows from the group over there?
Won't change your lifestyle. Yeah, emotional time, monetary and emotional time.
Yeah.
Yep, and money.
Mate, the very active trading. The very active trading is trading your time, which you cannot replace,
yes,
for potential money, which you can replace. And that's a concept that escapes a lot of people. The goal part is something else that people need to focus on before they start. The difference between arithmetic and geometric growth is represented by a very famous dead person, Einstein, the power of compound being the greatest mathematical discovery of all time. And that is absolutely awesome when you sit down and do the numbers on that. I shared one with you briefly, Gary, today. If you start with $1 and you double it 21 times, so 1, 2, 4, 8, 16, etc., etc., what do you end up with after 21 doublings?
It's quite extraordinary. My initial, I must say, my initial take on that was maybe a couple of $100, but it was actually over $1 million.
That's pretty mind-boggling, isn't it?
It is.
And I guess the people who run the banking system are very aware of that. Compound interest on your mortgage, compound interest here and there and everywhere.
Yep.
Okay, let's have a look at the DNA of the market, the optimal time window. All markets go through quiet patches and not quiet patches. Our lives go through quiet patches and not quiet patches, so we need to align those two. So for example, on this example here, if this is your optimal time window, well, it's certainly not the optimal time window for the market. The optimal time window just on this sample was in through there and down through there. So the two need to line up, the optimal time window for yourself as well as the optimal time window for the market, which will depend on the ranges and the spread and the character of the bars and the time of day. They'll all show you very graphically, as you'll see from some of the examples tonight as well, of the effect of the time of day. Just in relation to charts, many charting services use the typical red and green colors for down bars and up bars. What's the most common form of color blindness? Just happens to be red and green. My preference is to use purely black and white charts. You'll see some X's on screen beneath bars there, Gary. You're seeing the X's? 1, 2, 3 over. Aging Gary.
Yes. Sorry, I missed that.
Seeing the X's and the red.
Yes, all there.
You're seeing the X's and.
Yes.
Right. That's again based on time of day in relation to one particular market. And it's rather uncanny how the X's coincide with either a run or a reversal, a reversal, a reversal, a reversal, a run, bit of a run, there, a run, a reversal, sorry, a continuation down, a continuation up, a reversal. So there's many ways to be able to work with a market once you get up close and personal with the DNA of a particular market. Now again, whether you do that manually or whether you use software to do that, you end up with the same result. The example here is some software called Motive, I think it is, Apple software, and just programming the various parts of the language of the market, you can come up with probabilities in terms of frequency and then probabilities of the outcome. This is referencing the Aussie dollar US 20-minute time frame. 23% of bars are spike highs, 20% are spike lows. Go to a different market and it seems to be reasonably robust. So around the 20% of bars that make spike highs, 20%, 21% make spike lows. So sit down, do the work, roll your sleeves up and get close and personal with the market that you want to trade before you start trading. And this is why the homework is an integral part of this three-part cyber tutorial. You can see the squiggle lines everywhere now, Gary?
Yes, I can.
The chart with the 4 or 5 lines? Correct.
Yes.
That's a very graphic illustration of the time of day. The overall result of the rule set, the rule line, the black line through there, shows the overall result from beginning to the end of the sample. The red line is the middle of the day, and that shows a negative result. The green line here is the late session, that shows a positive result. The early session is the blue line, that shows a positive result. So by leaving out the middle part of the day, just using the early part of the day and the late part of the day, this is the result you get versus the other results. Now, something that was really apparent back in the 80s in the futures markets was in Chicago when the boys went for lunch, the market went into a quiet patch. Well, it seems that with the day and age of computers go for lunch and the markets go into a quiet patch as well. So what I'm stressing is nothing has changed in terms of the character of the market, whether computerized and high-frequency trading or what have you.
Yeah, there's a question here, Ivan. How much do you make of volume data?
Volume is an unreliable data source, and it's another data source. So the more sources of data you have, the greater the room for error. Short answer is 0.
Yeah. Yeah.
For the reasons before. Now, in terms of an RBT, a rule-based trading approach, most people focus on which part of the DNA of the RBT, Gary?
Which part?
What do they focus on?
Oh, the payoff.
They go, oh wow, we started there. Yeah, we started there and we ended up there, and hey, we'll all go to Nirvana. Unfortunately, the devil's in the detail, and this is simply a equity chart of looking at all these little squiggles to see what they mean in terms of whether you'll be able to follow the RBT. And this particular one, yes, it has a good return. The strike rate is only 44%. A lot of people go, oh, I need to have a strike rate higher than 50% to make money. Clearly, that's not accurate, it's not true, but it's a feel-good factor. I asked before how many people like to be wrong or lose money, and most say, no, not me. Now, what does it mean when you establish that a strike rate is less than 50%? What does that mean, Gary?
Well, you're taking more losing trades than winning trades, essentially. So your strike rate.
But what it means, what it does mean, Gary, is when you put the order on, you know that on probability, yes, it will not be a winning campaign.
That's correct.
So instead of going in there starry-eyed saying, hey, this is my big winner, stats show you that 56% of the time, you'll be losing. Or 44% of the time, you'll be winning.
Yep.
So it prepares you forward down the track as to what the outcome will be, or may be. The maximum draw, okay, it's a nominal draw, 10% or 9.4% if one's using 1% as. But look at how many days in a draw. 79 days.
Yeah.
25 campaigns in a draw.
Yeah.
So 79 days divided by what, 22? That's like 3 months plus, right?
That's right.
Now, would you have the emotional whatever it takes to pull the trigger on the 78th day? How about the 35th day?
That's right.
Only you can answer that. Depends on your preparation, depends on your DNA, and depends on the match of the RBT and your own DNA.
Yeah, just while you've got this screen. I was just going to say, Ivan, yep, just while you've got this screen up here, there's a comment here that your risk reward must be 2 to 1 or greater.
I don't believe in risk to reward. But yes, mathematically it's accurate. You look at the average win here is 2.04, the average loss is 0.90.
Yep.
So mathematically, yes, it must be.
Yeah.
But what I don't believe in, or nor do I use, is the risk to reward concept when putting on a campaign. I've got no idea what the reward will be, but I know what the risk will be. So if the risk is acceptable, I'll pull the trigger, outcome unknown. If the risk is too large, doesn't matter if it's got a 90% probability of success. What if that 10% comes along? Whoops, I have to get a real job, get a tie and move back to Australia. Nowhere known. Make sense?
Yes.
Okay, so rather than focusing on all that, focus on the detail that's contained in there. And again, this can be done with a calculator, it can be done with pencil and paper, or you can harness Excel or some Amy Pro or Metastock or MP4. A lot of programs will produce stats. Whether they produce all these stats is a different question. And the other question is, what stats do you need to match up with your personal DNA? Everyone will be different. One stat that to me is always important to look at is the number of 1-hour losses. That's nudging almost 50%. Half the campaigns went out for a full 1-hour loss. In other words, your entire initial stop loss got hit. And it's a matter of whether one's comfortable with that or one is not. If one's not, then you go hunting for a different RVT, a different approach.
Yeah, so the question now is, what is a 1-hour loss?
Okay, what is R, first of all? R is a fixed percentage of your account that you risk every single time. So that could be set to 0.5% of your account, or 1%, 1.5%, maximum 2%, but nowhere near 3, 4, or 5. That's suicide. So R is 1%, a fixed percentage of your account. So 1R means that you've lost that fixed percent, that 1% of your account, or that 0.5%. You know what your risk is because you know what your entry level is, you know where your initial stop loss is, and that represents your R in points. Does that cover it for the question?
I think so. Just another comment here, some strategies don't use stops, so the risk must be seen from backtesting.
Yes, that's a very valid way to establish the reliability of a concept.
Yep.
And then you start to optimize and start to bring in rules as to where to place a stop. I'll be covering more of that in detail in a few minutes. Okay, on screen you're seeing a 8-hour view of a market. This is the gold market, gold futures market out of the States. And again, every bar is marked with a message. And this particular rule set produced that in the last 13 months with 3 markets. So whether if your R is 1%, let's produce just over 250%. A different one here, just with one market, intraday, each bar is 10 minutes duration, and it's for a part of the day, like 3-4 hours being head down, tail up. And producing days like that is not out of the norm, where it's a 4-hour return. And again, that produced since July 2014 has produced this for the student. So everyone's different in terms of time availability and how close they want to be to the market and how much money they're trading with. So the novel way to view results of risk-taking, aka trading, aka taking a gamble. How many people here see that trading is gambling versus taking a gamble?
Let's see if we get some answers on that. Educated gambling. No, not me.
Educated gambling.
Yeah, no, not a gamble at all. It's not gambling, it's a passion. Calculated risk. Playing the probabilities.
Okay, so what we're seeing is the very act of living is a gamble. We don't know whether we'll cross the street alive or dead, but we take the gamble. Most people take on gambling as opposed to the gamble. The house is the one that gambles. The house knows when to lay off, when to take the bet. And that's, to me, the way to approach trading as well. Acknowledging that there is an element of dealing with the unknown future, therefore it is a gamble, but because it's part of a disciplined process, it's not gambling. On screen you can see the dollar-based and the R-based equity curves, Gary?
Yes, can.
Correct. And money tends to be emotional. Whereas talking about an R-based return, we go, oh, okay, I ended up with a 13% return. Okay, the highest was 22%. Started with scratch. On the money side, started with 50 grand, went up to almost 65. Oh no, I'm down in a hole. I'm down to 61,000. Rather than focusing on the fact that one is up, the money side creeps into it. So the money is emotional. The non-money representation of results is unemotional. So what is R? R is a fixed percentage of the account that is risked, always the same, never changes. So the generic example, which you have on screen there, Gary?
Yes.
Great, the account balance of 10 grand, and if the R value is set at 1%, that means that every time you pull the trigger, your maximum loss is $100, barring the market gapping over your gap, of course, and slippage. So because your entry is known, in this example at 100, and your ISL is known, then you know your risk is 10 points. Each point is worth $10. Therefore, your bet size is 100,000 to risk $100 in dollar risk. If the risk is 20 points, then your bet size is smaller. It's only 50 compared to 100. If your R value is 2%, whoops, as opposed to 1%, and the risk is 10, you can have a larger bet size. So what you do by having a fixed amount for your bet size, as in the R value, you're always having the same size potential loss. Let's have a look at an example of dealing with the profit side and how to account for it. You have a new slider on top with the long at 100 in blue, Gary?
Yes.
Great. So you went long at 100, got out at 115, profit of 15 points, $150. So your R was 1%, so you've got a 1.5 R return, 1.5% on the account. If the R value was 2%, what you got an absolute return of 3% on the account. On the downside, you went long at 100, incurred 100% loss of your R, got out at 95, loss of 5 points, and there's your 1R figure that comes into it. That should directly address the question before in relation to R value.
Yeah,
if it doesn't,
yeah.
We can come back to it or send Gary an email or myself an email.
Yeah, Alan's got a couple of questions around that. I think that should fix that.
Okay, now just looking at a graphic. You got the graphic on screen there,
yes.
Gary?
Yes, that's there.
Chart, correct. So the entry is known at 100, stop loss is known at 95, so the risk is 5 units, whatever it is, and it's a fixed percent of your account, therefore it's known as 1R. The market then goes up and you get out at 108. So what do we have there? You then have a profit of 8 units, which is the difference from there to there, and your R-based profit is 8 divided by 5, being your risk in through that. That gives you a profit of 1.6 R. So it's a really straightforward way of dealing with numbers, and the numbers can get quite large when you're trading the markets. If the account was 1%, 1.6, the account was 2% of the bar was 2, then the absolute return is 3.2. Now this is being recorded, so anyone who's not keeping up and they're not taking down notes and their shorthand is not up to it, the recording will be up on the internet somewhere, sometime. Gary?
Yes, it will be. We'll have it up tomorrow.
Tomorrow.
Yep.
Tomorrow morning, tomorrow afternoon?
Tomorrow morning.
Very cool. Okay, and this is an example on screen now of an R-based equity curve, same rule set, and the bottom right-hand corner is the dollar-based one, and the R-based one with R at 1% ended up being 41R, which is an increase of 41%. The dollar-based one went from 10 up to 14,009, which is a larger percent increase than the R, because the dollar-based one can take compounding into account, whereas the R-based one does not take compounding into account. And let's face it, if one is of any age, I guess, to trade for compound returns, for geometric returns, is far more attractive than to trade for purely arithmetic returns. Would you not agree, Gary?
Yes, that's right. And just on that, Ivan, there's Alan's sort of asked or made a statement here. Said so. The idea is to fix a position size to match a 1R or equal to percentage of the capital risk, which is, I think that sums up.
Correct.
Yep.
Spot on. Spot on. And the percent of your account that you risk will be dependent upon your RBT. And what I mean by that is if your rule set gives you the opportunity to have 5 campaigns in one day, one 24-hour session, and if you pitch your R value at 1%, that means potentially you could see a drop in your account of 5%. True?
That's correct.
So therefore in 1 week, 25%. Also true?
Yes, that's correct. And the opposite is true.
Now, so pitching an R value at 1%, where you have 5 opportunities per day, 25 for the whole week, means emotionally you can destroy yourself, and financially. So one would be better off to pitch the R value at maybe 0.5% or 1/3%, rather than sticking to the mantra. Everyone says never risk more than 1%. Well, the mantra is not real. The 1% depends on the equity, on the RBT, and depends on the DNA of the person trading it. So it's not a simple saying, oh, never risk more than 1%. Now, in terms of charts, most people look at too many bars on the screen, and then they compound the problem. You see the next chart with some moving averages and Fibonacci lines, Gary?
I've got a blank chart there. Oh, there we go. Yep, got it now.
Blank.
Yep, now okay, I've got cool.
So we're getting the Fibos and the moving averages and the parabolics, and
yeah, the SAR.
You're getting paralysis by analysis, right?
That's right.
And then you go to something like that. You got a black chart on screen now?
No, not yet. There we go. Yep.
Patience grasshopper. Patience grasshopper. Okay, so other people, like, everyone's different is the point that I'm highlighting. Black and white works for me, but no indicators at all and too many bars on screen. This one works even less for me. I guess either the person's colorblind or something. They like their car-rich colors. It's way too much. I'm a very simple man. That's the maximum number of bars I want to see on the screen. No more than that. So that way I can interrogate the last bar and say, okay, what is the true message in this last bar? For those who are not familiar with candlesticks, just a quick rundown on what candlesticks are.
Just a second.
The open is the higher.
We're waiting for it. There we go. Yep.
There we go. Yeah. So candlesticks have a thick part of it, which is the difference between the opening price and the closing price. If the closing price is lower than the opening price for that period, it will be filled in my version black. If the opening is lower than the closing price, it'll be white, not filled in. And then you have the relevant points of the open, close, high, low. Upper shadow is that small little thing above the real body. The lower shadow is that small little thing or big thing beneath the real body. So question for everybody, what does the opening price represent? What does it reflect? We know it's the first trade of the period, but what does it reflect in terms of the players in the market?
Just while we're getting a couple of answers on that, a question here, if your R-based performance starts falling, do you start investing less?
Your R-based is always the fixed percentage.
Fixed percentage.
So as your account decreases, your bet size reduces as well.
That's right. Does this work on a weekly time frame? There's your homework. So the opening.
One aspect in relation to time frame of the charts, Gary, for anything to work in inverted commas, it must have what I call universal truth.
Yeah.
So it should be able to be applied on a 3-minute chart, 5-minute chart, 13-minute chart, 30-minute chart, 3-day chart, a weekly chart, monthly chart, and we don't live long enough to apply it to a yearly chart. Otherwise, the concept's suspect. So back to the opening price. What does the open represent in terms of the market players?
We've got equilibrium on the opening auction, point at which the buyers and sellers agree on price. Amateurs
That's
making a pitch.
Gary.
Yeah, at all. These are some
That's
of the
from a textbook, Gary.
Yep.
Right. The reality is the opening price is decided by both the buyers and sellers based on what happened before the open as to whether they should be long, whether they should buy, whether they should sell. And the open tends to be an emotional extreme quite often. What I mean by that, the open tends to be within X% of a bar's high or a bar's low. So it's the coming together, yes, but it's based on what they should have done but didn't do on the last period. What does the closing price represent?
What
does the closing price represent?
The last of the known information, or where they're willing to be at that point of the time.
The close represents their own projection of the future.
Yes.
If the market closes right down on the lows, well, the traders who push the market down to the lows, i.e. the sellers, believe that why take profits now? Because they believe that next period, the market will go lower still. So it's actually a projection of the future. The high price represents the very tick where the sellers overpower the buyers, where they're stronger than the buyers. Not more than, because the law of contract says to make a price and you have one buyer, one seller meeting up. But it's the aggression of the sellers that overcomes the power of the buyers. The low price is where the buyers overpower the sellers. So those four data points are crucial in my mind in terms of reading the message of the market, the language of the market. Excuse me. And the language of the market consists of the alphabet, which is just a single bar, which then morphs into 2-bar combinations or words, and then into 3-bar or more combinations and sentences, and finally into setups. So let's have a look at some very simple 1-bar alphabet of the market. A one-way street, simply opening at the lows, closing at the highs. When I say at, make it 5%. Within 5% of the low, 5% of the high. Do some work, see whether the 5% is accurate. Maybe it should be 3%, maybe it should be 6%. Profit taking enters here where the buyers have pushed the prices up, and more, they haven't been able to do battle with the sellers, so maybe the buyers are just getting out of their position, but a profit taking coming in. The next one here, the selling overtaking by buying. The market opens there, trades down to the low, and that brings in the dip buyers, and they push the prices up, not only back to where it opened, but to close above the open and thereby creating a white real body. Another one, this one here, probing for sellers. So again, we opened there, traded all the way down to there, didn't induce fresh selling. The market then rallied up to close up through there. And then the flip side here is probing for new buys, whether they're probing for stop loss buys, which they may be, or fresh buys, it doesn't matter. But the market made it all the way up there, but then the sellers overpowered the buyers. In terms of down buyers, exactly the flip side, the one-way street, the profit taking closing up from below, the little wick up the top where the buying is overtaken by the selling, probing for sellers down here, probing for buyers up there. That's the part of the language of the market. Now, where this becomes really fascinating is when you do some simple back applications, taking the S&P 500, for example. It closes in the top half of its range. It only happens 59% of the time. 69% of the time, the market will be higher the next period. And 57% of the time, it will close higher on the next period. So I recall a question early on, Gary, I think you do as well, of someone who said, well, the promise is pretty useless because it goes to the high and that's it. Depends on where it closes based on your stats. Move across to closing in the top quartile, 75% of the time will make higher highs. Now that's really insightful in terms of what to do with it, or what side of the market to be on. You don't want to be fading that. You want to be going with that. So this is where I'm coming from. Come up with a hypothesis, sit down, pencil and paper or computer, and just crunch the numbers. And you can do that visually. So we're seeing the cheat sheets on screen as well?
Yes.
Correct. So let's just start from the left-hand side here. We've got the little bar in there with what does it look like? Sort of looks like this one, doesn't it? Just selling overtaken by buy, but not strong. The next one certainly is, isn't it? You've got the lower shadow down there, and closing well and truly above that. Then we have a one-way street in through that. Then we come down for 2 bars, and we have probing for sellers. Another one here, black one, probing for sellers. So each bar is analyzed, is interpreted, is categorized in relation to what the buyers and sellers are doing in the market. So clearly a one-way street, the sellers are the dominant force. So there's been a profit taking by the sellers because they believe that, hey, why get out of that short? Because the next bar will be lower still. Next bar, this one's off the lows, so it's different to that one. That one's on the lows. So it's that eye for detail that really comes in. This one here, closing right on the lows. Virtually guarantees the next bar will go lower. But to use the word guarantee is dangerous and socially unacceptable, so I won't use it. Let's move on in terms of language of the market. And then you have 2 bar setups, where it's just 1 bar, another bar. So this one here, clearly, I want to go up. This one, you're seeing the 2 bar combination going?
Yes.
Great. Yeah, I'm just conscious of time as well. The 2 bar combination, I don't want to go up. I want to go down. I don't want to go down. This is all part of the language of the market, which then morphs into sentences and finally into setups. And then we have other 2 bar combinations. This one here, most people would recognize as an inside period, right? Well, in terms of market players, I'm confused, says the market. Next one, people will recognize that as an outside period. Maybe they'll recognize that as a key reversal down or a bearish engulfing line. You're confused now, right? Is it going up or is it going down? So what happens with a bar like this one, Gary, where it takes out both the highs and the lows?
It actually,
or this one over here, taking out the lows and the highs.
Yeah, it can create a 1R loss on either side.
What it does, it empties the bus.
And empties the bus.
Anyone who
yes.
wins.
Yes.
And that's a really, really important point. Because when does the bus move more quickly? When it's loaded with people or when it's empty?
Yeah.
So this sort of pattern, to me, is a magic one. And again, you can create a standalone rule set around just the outside period, as you can with any of these aspects of the language of the market. And again, sit down with a chart. This has been so people will be able to do that and go through each question. Okay, what do we have? Oh, confusion there. Oh, what do we have here? I want to go down. This one's smaller or larger. If it's larger, I want to go down. And we go down, but later on. This one here, I want to go down. I'm confused. I don't think there's any you're confused ones here. Another one of I'm confused in there. Are you sort of getting the idea, Gary?
Yes.
So you're a proxy for the audience, right?
That's right. We've just one question is what time frames are we talking about? And I think we've covered that at really any time frame.
This particular one is 3 hour. I prefer to use non-standard time frames because everybody uses hourly charts. Everybody uses 4-hourly charts, and when you do the same as everybody, you end up with the same result as everybody.
Yeah.
Next question.
It's just a statement, very simple chart Ivan has there. The complicated ones are the ones we steer clear of, and there are more and more of them. I don't know about that.
I would challenge that person to send me an email with a copy of the charts that he's referring to. Yep. And I'm happy to spend half an hour on Skype just to address that particular question.
Yeah.
leading it into the promise question?
Yes, and I think this...
You're about to read that question?
No, that's all. Are we good?
Okay. Again, on screen is an example in the gold market, and gold actually is a currency. A 12-hour view. Now, most people look at daily charts, maybe 8-hour charts, but not 12-hour charts. And again, clearly we can see examples here of the promise of higher highs, the promise of lower lows being fulfilled and providing opportunities. And up here we see some of the stats in this market on this time frame. For the longs, 66% of the time, 75% of the time on the short side, the promise is fulfilled.
And you
There's
can
an
see
RDT in the making then.
I just point out, Ivan, you can see the I'm confused bar at the top there.
This one here.
Yep.
Yep. And the bus has been lightened down here. I'm confused. No, you're confused. I'm confused. Marcus confused. This one here is a nice one too. That's a great probing for new lows.
I think this is a really great example of the homework as well, because it's a very simple, there's no second guessing with this, because you can see the larger range bars leading on to further movement. So there's no guessing about finding lows and that type of thing.
And there's no lines, and there's no indicators, and there's no volume, and there's no open interest, and there's just the purity of the price itself. It's the old-fashioned days before I was born. It was called reading the ticker tape. So there's your homework again. You got the chart of the homework again there on screen, Gary?
Not yet. Just a question, Ivan. Does a promise up bar have to open higher than the previous close, and vice versa?
Okay.
I think
the answer's on screen.
That will answer that.
So it's those 5 points, and only those 5. But that's a great example of the sub-C coming in and saying, hey, what if?
Yep.
So simply the range is larger, the high is higher, the low is higher, the close is higher, and the body is what?
Yep.
That's all. Next cue.
Do you subscribe to the concept of horizontal support and resistance?
No. Support and resistance is, people leave out the word potential. It was, it may be, but it's not until it's proven. No, I don't use any support, I don't use any lines, any support and resistance, only pure price action, the bars themselves. Okay, this is an interesting one. Let me pull up this one. So there we have live markets with the Euro 4-minute chart and the cheat sheet down the bottom of the screen. And you can start looking at the last bar and saying, okay, what's the message from the last completed bar? This one here. What was the message from the last completed bar?
Probing
on the cheat sheet.
Yeah.
Yeah. Just came home to roost, and guess what? This bar is going down. So if that's part of your rule set, you should be short. The question is, where should you be short? On the close, on the break? Again, that's a matter of sitting down and back applying, back testing a number of different entry concepts. Worked up, again, it's a matter of sitting down and playing with the various exit concepts. At the high, above the high by average true range, above the moving average, they'll all have different outcomes. But the message there is clear and unequivocal that it's been probing for highs in there. Not like this one, but buying overtaken by selling. And that's the subtle difference, Gary, between this one here and this one here. And that disappeared. There we go, back on screen. The reason I'm using 4-minute charts is simply to speed up the process of recognition. We'd be here forever and a day looking at the hourly charts.
Yes.
Not that I mind, but...
so another question here, do the 2 bars in the promise bar system need to be of the same color?
Okay. Let's go back to the definition. Does it Does it reference the previous bar being white or black? No, it doesn't.
Yep.
Just in this diagram, it is.
Yep.
I'm a very pain in the ass literal person. Either it is or it isn't. No more, no less. So what's written there are the only things that are important at this stage in relation to a promised up bar and a promised down bar. Keep it simple. Okay, and there's an equity created using purely the promised bars, going from 0 to 31R, a sample size of 174. And the thing always to bear in mind, stop looking at that part of it, but look more at these parts, the drawdowns. This one's time pain. That's time pain. There's no large drawdown. This is large time pain. So you've got to sit through it and sit through it and sit through it. If you have the appropriate capital, the emotional capital. Now, one can automate the recognition of promises, or one can do it manually. On screen is an example with a program that I use for this of automating it. Yes, Gary.
Just a question, what's the difference between I am confused and you are confused?
An inside period, the market's confused.
Yes.
An outside period, the traders are confused. It breaks the high, breaks the low, what's going on?
Yes.
Whereas an inside period is the quiet before the storm, if you will. That's one that you're playing with, I believe, Gary, too.
That's right.
There's another one in there. There's
Yep.
another one in there. There's another one in there.
Yep.
There's another one in there. And there's two together. So those two are different to that one by itself. Again, the devil's in the detail, right?
That's right.
Okay, now let's put this together a little bit more. And RBT, rule-based trading, the one thing that is required for success in the markets is what? Is volatility. Volatility is movement in price. And the Chinese symbol for volatility is danger plus opportunity. One aspect of trading and success in trading is to get your head around the various components of an RBT, which are your entry rule, your initial stop loss rule, your sizing rules, your campaign management rules, and your exit rules. So we've got 1, 2, 3, 4, 5. Can you imagine a 5-dimensional cube? Because that's what you're dealing with. You change any one of these, anyone within any one of these, and suddenly the profile, and hence the path. In terms of entry concepts, where do you enter a map? On the close, on the next open plus, at the extreme of a bar, on the break of a bar, on a retracement, on the next open. And the best one I heard that I shared with Gary today was in a broker's office when I was running an in-house course years ago. A client rang up and said to the broker, buy at market or better for me. Like, hello, buy at market means you're prepared to accept any price you can get. How would the broker know what's going to be a better price or not? In terms of numbers, and this is again jumping into next week, but you give you a bit of a cameo, different entry rules, and look, 1, 2, 3 over.
Yes.
You're seeing the entry concepts going?
Not yet. Just while it's coming up, there's a question here about what is campaign management?
Yep. The question is?
What is campaign management?
I feel like I'm barking in the wilderness here, Gary.
Yes, you are a little bit.
I didn't hear a word you said.
The question is, what is campaign management? Not going that way?
Say again, Gary, please.
Well, what is campaign management?
What is campaign management?
Yes.
What is campaign management is the question?
Yes. I've just put it through on Skype for you.
1, 2, 3, 4, 5.
Just put it through on Skype for you.
This, Gary, you're seeing a new.
I've got different entry concepts on the screen.
Okay, campaign management is simply you enter, and how do you manage that campaign? Where do you add to your position? Where do you take off profits for that position? That's part of campaign management. Then your sizing is, if you're adding to a position, you're adding to a winning position, how much you're adding to it? You're adding 1 for 1 or half for 1. So that's campaign management. That came across?
Mm-hmm. Yes, that's good.
Great. Looks like the gremlin's gone home. Now, different exit concepts, again, could be it. Based on profit stop, protect our stop loss, the racetrack exit. They're all different concepts of how to get out of a trade, out of a campaign. And again, they make a big difference. Example here, from 2.8R up to 40R, different exit concepts. The same entry rules, the same campaign management rules, but varying the exit concept, 2.8 versus 40.2. That's a market difference. Let's have a look on the chart. Different concept. Again, this is using one initial stop loss concept, produces just on 50R. Using a different stop loss concept, produces more than double. So the point I'm driving home is the entry matters, the exit matters, and the middle part, the campaign management also matters. So just back to the end, look, investigate, verify for risk, and execute before you jump into the market. And they're the 12 setups that I actually use and share with people, the rare person who makes it through my front door to come under my wing, so to speak. And we all start out with the same blank Rubik cube, and then we start seeing a bit of color in there. And the idea is to get all the pennies in a row, all the ducks in a row before you jump into a campaign. What I've done is combine the setups with different rule sets, such as the aggressive ambush, all very colorful names and very descriptive. The top down being a 2 time frame, top down 3 time frame, coattails. That's one of interest to promise traders or people working with a promise. Bread and butter I shared with you tonight. Lifestyle one I shared with you, sniper. So they're all just combinations of rules, of setups on when and how to use them. So what we're doing in the 3-part session is to give you the introduction, which I've done poorly, I believe, and then next week spend far more time with the details of the entry techniques, of the stop loss concepts, and also how to apply the multiple time frame approach. Everyone's still there, or everyone's gone away?
It's all good. So good. We've had a question on yes, we've had a question on explain the entry rule, but I think you've covered that now.
Many different entry rules, and I'll cover that in more detail.
Sure. Yep. Just comment. Awesome webinar. Very high level concepts.
Thank you.
Yeah, and I think in summing up, Ivan, in doing the homework, without getting too far ahead of ourselves, it really is important just to just do the homework and see where it goes.
And part of the homework is to derive the stats in relation to promise up and promise down, and to allow your subconscious and your imagination to come up with any harebrained or otherwise idea of how to take advantage of the stats that you put together, which means you'll need to come up with a hypothetical entry rule and a hypothetical exit rule, and we'll just play next week and the week after.
Yep. Yep.
And they're the 5 charts coming across on screen. That's the, you're seeing the page with the numbers, the percentages?
Not yet.
Great. Okay, that's part of the PDF homework that Gary sent out to everybody.
Yes, now that homework is in the handouts box on your go-to webinar screen. The complete homework is there for you, and there's also an offer that FP would like to make as well for all the participants in here, and we'll have a recording available tomorrow morning by 11 o'clock.
Excellent, thank you, Gary. Now, in terms of downloading from the magic box on GoToMeeting, people can only do that whilst the meeting is still on, right?
That's correct. So
obviously,
we'll leave it on for a little while.
How about we have a pause here? I'll just grab a drink,
Yep.
Of coconut juice, of course, and fire off some questions as people download for about 5 or 10 minutes.
Okay.
Make sense?
Mm-hmm.
I'm sure you can have some questions coming.
Yeah. So, well, there's a question. Can you please give the answer to the homework? Okay.
Wow.
Okay.
I'll take that with a grain of salt.
Okay. Just someone's
actually, yeah, I can. The answer is what's the meaning of life? 42.
42. That's it.
42 is the answer.
Yes.
Yeah. Now, how does that help the person?
That's right. That's right.
So the answer is 42.
Yep. So we also, I see you've got the slide up here on your book. We also should mention, to really encourage you to have a look at the homework and work through it, we're going to give away 3 copies to the best homework received. Now that's not 3 copies to the one homework, that's 3 separate, 3 separate copies. We'll be reviewing every piece of homework that comes through. You don't need to be concerned about that. We will be reviewing everything, and so the have you got the slide there with the email address, Ivan? That's FX Homework at FP Markets.
That should be on screen by now, depending on the tide.
On the tide, yes.
Is it high tide or low tide?
No, you've got Cyclone Pam Category 5. Nice going. There we go. So
that was a big one.
So specifically for this tutorial series, we have a new email, fxhomework@fpmarkets.com.au. Send all of your questions there, or certainly send questions, I should say, to Ivan. Send your homework to fxhomework@fp Markets, and I'll be going through it all. And we'll be looking for three winners of a copy of Ivan's book. And I think that's about all we have. And it'll be the same time next week.
And with a bit of something, the connection will be much better.
Yeah. Someone said that they have
any questions coming through.
Someone said they've got 46 bars. I think they need to go back and have another look. Do you prefer the OTC or futures markets to trade FX?
The purest market of all is the futures markets, because this comes from a centralized exchange, whereas the FX markets are out there somewhere. You never know what the real price is.
Yeah.
I'm not saying it's a negative. I'm not saying.
When is the homework?
The futures market is.
Sorry.
When is the homework due? Between now and then. Obviously, if the homework's not done before next week, then they can't be in the running for a prize, nor can they be in the running for us to work with our RBT.
Yeah.
Right.
That answer 42. The question is it SMA or EMA on that 42?
Is it displaced or otherwise?
Yeah. Yeah, that's good. So yeah, the homework by next week. Many thanks. Thank you. Thanks everyone for coming out. I should say that. I would again stress to you, take on the homework. It's not that hard to do. I got through it, so it's not that hard to do. And we'll look forward to seeing everyone next week. I think there's where do we get the homework questions? There's a little download box on your go-to screen, Tom. If you can't get the homework, just send an email and say, I can't get the homework, and I'll send it to you tomorrow. I think that's all we've got.
The barrel is empty, huh?
Yep. Ivan, do you use some form of auto trading, or do you sit in front of the screen and run your campaign manually, so to speak?
The latter.
The latter, yes.
I have a love-hate relationship with technology. I've been using computers since 1983, and I know that they are not perfect. So some aspects of what I do, yes, computers are good, but the final decision has to be mine, not auto. There's so many things that can go wrong with auto. As they can go wrong with trading manually, but at least the buck stops with me. I can't do anyone else.
Yeah. There's a question there about page 7 of the homework. Is it for your perusal? Yes, we would like to see it come back. As Ivan mentioned, you can take a photo of them, you can scan them, you can, what else can you do? Photo, scan.
Get someone to transcribe for you.
Get someone to transcribe, post them in. Level 5, number 10.
Get some greaseproof paper and trace it.
Yep. How many markets does Ivan trade?
How many markets do I trade?
Yes.
Or how many markets do my RBTs address?
How many markets? 3. Yep.
Example. 3.
I'll ask a question out of that question. Is what is your favourite?
I'm not attached. I give it ...
Yep.
It doesn't matter. At some stage, one market is not performing. The other two are. Another time, different markets performing, and the other two are not. So it all balances it out.
Yeah.
Now, whenever a drawdown appears, the first thing I look at the equity chart and go, what am I talking about? Like recency is real. Oh, it's been a bad week. It's been 3 or 4 losses in a row. So what? It's been 79 losses, 79 days in a draw before.
More questions. Which 3 markets?
Which 3?
Yes.
Come back next week.
Okay. Okay. Good answer. Another question about the homework. How big should the real body be? Read the homework.
Refer to the notes, and does it mention the real body?
That's
it doesn't.
No.
It just mentions the high, the low, the range.
That's actually the range. That's right. Why only 3 markets?
That's literal. Because that's enough.
Does Ivan teach any psychology? I want to embody his trading psychology profile.
It's all about psychology. Life is about psychology. So the short answer is yes, of course. It has to be a major part of it. The setups themselves are not magic. The rule sets are not magic. But where the magic comes from is the application of that knowledge together with some dollars and the emotional capital.
Yep.
That's the challenge.
Are the homework charts available as a CSV file? I don't think so.
Negative.
But, yeah.
No. This is about visual recognition.
Yeah.
Learn to drive a manual car first, then go for a Slashbox automatic.
Yep.
Giving away my vintage, of course.
Yes. Can we access the candle charts? I think he means cheat sheets. Yeah.
Yeah, they're in the recording.
They're in the recording. That's right.
Do a screen capture, alt print screen, and then into a paint program, and they have capture the screen.
Yep.
So alt print screen when you're running the video. Pause the video. Alternate key and the print screen captures it into a clipboard and invisible place nowhere, and then you put that into a Word document or a paint program,
Yep.
And Bob's your uncle, unless George is.
Yep. We get out a piece of paper and a pencil and draw them out.
Exactly. I'm not that sadistic, thank you, or masochistic.
Ivan is revealing he's a techno geek. Okay.
I've been using computers since 1983. Does that make me a geek? Let alone techno?
Okay. All right. That's all
Like
good.
technology is there to be used, but used wisely rather than indiscriminately.
Yep.
Is what I said.
How many days a week and hours
For example, I don't
does Ivan trade?
store I don't store anyone's telephone number in my mobile phone because I respect the passage of time and I respect the reality of Alzheimer's. So if I don't exercise my brain, I'll be comatose pretty soon.
Yeah.
Turning 65 this year. What was the question?
How many days a week and hours does Ivan trade?
Trading 8-hour bars and 12-hour bars is about 5 minutes per rollover.
Yep.
So do the maths.
Yep.
I don't sit in front of the screen and become a screen jockey and trade short-term movements. And the reason for that is that's where I live. That's my backyard or my front yard, depending on which way you look at it.
Yeah.
And I also recognize the pollution and the blue light that comes out from the computer screen, so I go, that's enough. Time to go out and touch Mother Earth.
Okay. I think that's it. I think that we've got that, Ivan.
Excellent. Well, thank you, ball boys. Thank you, umpires. Thank you, Gary. Thank you, FP. And thank you, Internet.
Yeah.
Jolly good fun.
All right. So I'll leave this screen on here for a little while. We'll leave this up for a little while, and